business ecosystem, one of the most important things is finance. Luckily for us, the government of India is very, very pro-cashew. There's lots that's happening in that space as far as the investment is concerned. The question is that how you as an entrepreneur, as a business owner, or as a part of the cashew supply chain get access to those funds. And that is why I have a feeling that this is probably now the final day of AICA is literally the most valuable day of the entire conference. Moving on from our first presentation into the second panel, which is equally crucial to any business, we are talking about financing the cashew business. What are your options? What are your opportunities, and what exactly is the selection criteria to avail of these opportunities? And in order to delve deeper into this topic, I would now like to invite the session's chair. Please put your hands up for the partner Dryfruit Factory LLP, Mr. Veeral Desai, who will be chairing this session for us. The contributors to this panel are the Chairman and Managing Director and CEO of Aelea Commodities Limited, Mr. Hozefa Jawadwala is in the house with us. A BCom, a CA, started as a banker, moved on to trading companies, rich experience across commodity entire value chain, and he has worked in several organizations including Olam, EDF, and Manbin at the helm of Aelea Commodities since 2021. It is one of the few listed companies in the cashew business. Next contributor to this panel, the founder and director of InVed, Mr. Mohit Jangir, is the founder and managing director of InVed Research based in Jaipur. He is a long-term equity investor and financial analyst with over 6 years of active experience specializing in fundamental market research and private equity opportunities. Our final contributor this morning will be CEO and whole director of SPAN Divergent Limited, the management consultant for SPAN Consultech, Mr. Paras Desai, the CEO and whole-time director. And as our panelists take their place, I leave this session in the hands of Veeral sir.
Good morning all. At the outset, first of all, I thank AICA to give us the opportunity to conduct this wonderful session and with having this wonderful panel with me. And thank you all for joining the session on financing the cashew business. This session is to understand new ways of financing cashew business using private equity and offering shares to public through IPO. We'll try to learn from experience of people who have raised money through IPO, list the processes involved before approaching external investor, its advantages and responsibilities running a listed company, and get some perspective on apprehensions regarding commodity business valuations and costs. So just to set the tone of session, I'll go through this short presentation. So first of all, we know that what are challenges we are facing. Of course, import dependence on RCN. India has not enough production which can complement the processing capacity. Then price volatility, seasonality, high working capital, and also it's a capital intensive. So as we know, luckily our industry is growing. I think demand where, in India, yesterday only we saw in many presentations, I think India cashew kernel consumption is growing, and that's very positive that we are playing in the growing market. But that comes with many challenges. So first of all, we understand briefly where demand comes from. So of course it comes from daily dry fruit consumption, sweets and namkeen and confectionaries and horeca, and of course snacking and everything. I think during last 2 days we had enough of the presentation on this particular topic. And then of course we go to the growth implication. Higher demand gives processor room to grow in volume, quality, product, and market reach. So these are the 4 key factors where we can grow, basically. Now, this supply structure, or rather this growing demand, also creates a funding burden. And what's the capital effect of this structure? First of all, I think everyone, at least the processor, knows the large procurement payment comes before kernel sales. Origin-wise buying windows require quick availability of funds. I think we have all faced through and gone through these particular issues. Import dependency adds logistics, timing, and currency link pressures. And higher processing scale usually needs higher inventory support. So, as we know, it's a highly working capital intensive industry. Also, as we grow the size of the company, we need, nowadays with the technology available, we need to deploy more machines, more automations. So again, it requires more capital. Why, growth in cashew industry become capital intensive? I think I will not elaborate much on this because already you know most of the things. Of course, first is seasonal procurement. Second is RCN and kernel price movement, which is, we are in commodity business, so we are facing this uncertainty. Inventory holding period. Normally, I think, 3 to 4 months is a rotation cycle. Normally, I think everybody follows. Slack or lower utilization period. See, cash generation may be uneven, while fixed costs and capital remain committed. That's one of the biggest problem what I think we have. Some seasonality in the sales, in processing, everything, it's linked to our business. We can't avoid it. So basically, during that time, the cash generation is limited. But then our factory is running, our people are there, utilization, even working capital is already like blocked. So those things are still we have to service. Other thing is, as I told, automation and modernization, which is now demanding. And third is, the last is quality and market development. So better recovery, quality systems, new channel require upfront spending. So those are the requirement for the cash or capital. So the opportunity, growth, and capital need is explained in one simple step. The opportunity is there, growing domestic use. I'm not stressing more on exports because currently India is kind of out of exports. Practically, I can say 1%, 2% is nothing, no exports. Growth ambition, more procurement, higher processing, modernization, and then capital need, RCN purchase, inventory holding, capacity and automation, and industry challenges, import dependence, price movement, seasonality, working capital, capacity expansion. So these are the real issues what we have. I think to understand more about this, I think we must listen to the distinguished guest here who has, I think fairly recently, I can say in the entire journey, raised capital through IPO and very successfully. So I request Mr. Hozefa Jawadwala, Chairman, Managing Director and CEO of Aelea Commodities Limited, to share his views on the subject and this discussion. Thank you, sir.
Thank you. Good morning, and thank you, AICA, for this opportunity. I think raising capital is not a constraint at all. I don't know why we really have to think too much about this. But the problem is about to understand the purpose of raising capital. Now, until we are clear on the purpose of the capital that we want to raise, we will not be clear on the what kind of risk and rewards those kind of opportunities can create, and also what kind of time frame that we want to allocate for that kind of a capital. These three dimensions typically makes the entire structure clear, and then you can decide as to why and from where you really need to raise capital, whether private equity, whether public equity, whether long-term debt through banks or through some other channels. It's basically the purpose that first needs to get clear. So just to give you example of certain purposes, you can have a purpose of innovation, you may have a purpose of acquisition, you may also have a purpose of compounding growth, or you purely have a purpose of sustenance. Now, each of these purposes will attract different set of partners with you. You may like to have a co-pilot, maybe a private equity is a co-pilot kind of a thing. Or you may simply like to have a co-passenger, which is like the public equity, because they tag along with you, work along with you as a promoter. The other second and the key constraint is to understand the risk and reward aspect of raising capital. Public money or equity doesn't come cheap. Okay, the cheapest is bank borrowing. Now, some of you may feel that you are saying something wrong. You know, it's free. I don't have to pay any finance cost, nothing. Absolutely incorrect. It is the costlier money. It's a cost of equity. So, as an owner, if you really want to earn more than the bank rate, then that's exactly what you are sharing. This third aspect is the time frame. Now, if you are looking at something which is short term in nature, maybe a 12-month or 24-month kind of a time frame, where you basically are looking at an opportunity, then you will not go for a public money because it's long term in nature. The short term to medium term, which is basically somewhere around 3 or 5 years, is good to go for a debt, which is long term in nature. Multiple ways you can raise debt also is bonds. You can raise it through preferential shares, or multi other ways of raising through DFIs or whatever. There is another part, is slightly 7 years or above, where again you are very clear that you need for a very specific purpose, and once the purpose is over, you don't need that money. In those cases also, you can go for an ultra longer financing option, probably not equity. But equity comes in where the risk needs to be shared, the rewards needs to be shared. And where you as an entrepreneur feel that it's something which you cannot do alone, then you probably go with a private equity, which is basically like a co-pilot activity. Now, I'll just keep my opening remarks limited to this, but this is how, if once you have defined, are you clear about exactly what is your requirement and how much is what you require, then it's much easier for you to really approach the right kind of people and raise the amount you need. It's pretty much sorted thereafter.
Thank you, Sevaji, for wonderful opening remarks. I think we'll come to question answer later on. I hope definitely a few interesting questions. Now I request Mr. Mohit Jangir, founder and director InVed, who has been consulting and advising companies on fundraising, to share his views on the subject. Thank you.
Yeah. So, good morning, everyone. First of all, I think I'm pretty new to this group because people know Hozefa ji due to him being into the cashew industry. But We were one of the earliest investor into even Aelea Commodities, and we track this space very closely, and we find it very interesting. So whatever I'll talk, it will be from the market's perspective. I think it will not be from the industry's perspective. So, is rightly said by Mr. Hozefa that equity is the costliest way to raise capital. It is not risk-free. Many of you will think that, yeah, it is risk-free, but equity comes with responsibility. So as long as you are raising debt from the bank, you are liable to the bank. But when you raise from the public, then you are liable to each and every of your shareholder. So at that time, it is not risk-free. You have to share the reward, but you have to keep the disclosures up to date. So the banker will come to your office when you raise debt from him. He will keep tracking you. He will keep asking you for updates on day-to-day basis or week-to-week basis. But any investor, because he can be from Tamil Nadu, he can be from Rajasthan, he can be from UP, so he can't reach you directly, but he will also need some updates. So when any of the participant here who is doing cashew business, it is a pretty interesting business, but when you decide that, yeah, now I want to go public, then you should share some kind of responsibility with your public shareholder when you come into public equity. I think we will have further discussion on how can any company, when they decide to raise from public, even through private equity or through public IPO, how can they go about it? But yeah, that is it from my side in the opening remarks.
Now I request Mr. Paras Desai, CEO and whole-time director, Span Divergent Limited. Also a management consultant who is leading Span Consultech and who has been consulting and advising companies on strategic capital structure, business diagnostics, before equity finance or fundraising, and other corporate finance matter. So he also is a CFO and director in the company. Span got listed in '94, and since then it's a listed company. So one of the first listed company in that space. And I think he had various experience of selling the business to a Japanese company, and again recently raising capital through preferential issues, and so all complexity. On the one side he has handled personally, and also now he is into consulting arm. So I request Paras to share his view on the subject discussion.
Thank you. Good morning, everybody. And thank you, AICA, for giving us an opportunity to be on the stage and share some of my experience and perspective on finance and capital structure, particularly for the cashew industry. I will try to live or put myself at your place while giving you or by sharing my experience, so that it can be correlated and it will be kind of a real-time experience. Suppose you have a credit limit, CC limits of 20 crore. Your DP is 20 crore, and you already utilize 18 crore in your stocks, in your finished goods stocks and everything. And suddenly you get an opportunity to purchase a stock of 5 crore of RCN from Ghana, which is showing an excellent parity, which is a very competitive price, and you see that in the next coming 6 to 7 months, the price might go up. So I must seize this opportunity. But unfortunately, against that 5 crore of order, you are left with only 2 crore in terms of your DP. So this is the real-time practical difficulty or the constraint that you will face from your bank financing. Suppose you have a plan, you are running at 15 metric ton per day production plant capacity, processing capacity, and you would like to expand it to 25 metric ton per day. Of course, the bank finance is available, term loan is available, you get it, you install, you expand it to 25 to metric ton. But along with that, your permanent working capital requirement will also increase. And if you go back once again to the bank, you will find difficulty in getting your DP set once again. You have run out of your collateral, and then you feel that even though I have got a growth opportunity, I have got the capacity, but just because the financial, the capital constraint, I am not able to implement my growth stage. So this is where the traditional bank finance or the traditional working capital source put the capacity, put the constraint, and put the brake or kind of hold you back from your growth plan. And this is the time we should think about what other capital sources, what other capital avenues are available to us. But before that, before you embark upon those avenues, as my distinguished colleague on the stage has first highlighted, you must first be clear about what are the objectives of your fund that you are going to utilize. So it is important when you think about an additional capital sources or alternative capital sources, you must first understand how you are going to deploy those funds. Those funds could be procurement capital, like as I gave you an example for building inventory, making big purchase of RCN so that it become competitive, seizing an opportunity of a good quality of RCN. So some capital will go into that. Another is automation capital. You have a newer technology coming up. You must have seen in these exhibitions, AI-enabled technology, automation which can reduce the dependence upon workforce. So there you require a capital. So do you require capital for that purpose? The third is market expansion and seasonality. You would like to create a market, you would like to expand the market, you like to develop different geography. And third is your capability, capital like governance, management, ERP, AI implementation in your working. So these are the kind of purposes, objective of capital deployment. And for your business, where the major portion of capital is going to be there, that drives your decision for what kind of capital that you should choose for fulfilling your requirement. So, if bank has a constraint, or if you have reached the maximum limit of the bank finance, what could be the alternative to us? So these are the broadly classified into three kind of alternatives. First is structured debt, which is warehouse-backed finance, receivable finance, or non-convertible debentures. I'm sure you must be all aware about what is warehouse financing or what is receivable financing. In short, warehouse financing is that you purchase in bulk, you securitize this stock, you withdraw only to the extent you require and get finance against that. So it gets two advantages. You can get hold of the good RCN quality, you can build up the stock, but at the same time, you don't consume your DP limit. You can, of course, it has some cost on interest cost, but at least you have some manageable working capital management. Non-convertible debenture is another thing. If bank cannot extend more because of their norms, and if you have some financiers or some party, you can issue them non-convertible debenture where you can structure a deal in a way that you only make them the payment, the coupon rate, the principal amount can be negotiated to be paid maybe after 2 years, 3 years, 4 years horizon based upon your business plan and the cash flow planning. So these are the kind of structured debt that you can consider when the bank finance has reached its limit. The second is, we call it quasi-equity. It is kind of a hybrid between debt and equity, which is in terms of compulsory convertible debenture, OCDs, that is optionally convertible debenture, or the preference share. Here they start like a debt instrument. You don't give them the share in your business. You have certain structure, timeline. For example, optionally or convertibly CCDs, you say, again certain milestone, for example, you are expanding your capacity and you require 20 crore of capital. You issue a CCD of 20 crore. You say, when my first production batch, commercial batch starts from the expanded capacity, certain portion of your CCD will be converted into equity at certain valuation, because during that time your sales will increase, your EBITDA might increase, and then probably you will get the better valuation. From the investor point of view, he will wait, his capital is secure, because then he will convert and he will participate in your equity only when he sees that there are certain progress, or there are certain development, or there are certain success in your project. So these are the quasi-equity where they starts as a debt, and at the milestone, at the certain development, they can get converted into an equity. The third option is equity, the pure equity. Now, within the pure equity, there are different alternatives available. First is the strategic investor. Now, you must be knowing strategic investor, what it means. The investor which brings certain value, certain synergy to your business. He could be an RCN supplier, he could be a distribution company which help you bring your cashew to the consumers, or it could be a machinery manufacturer who can contributing by way of technology and equipment in your expansion project. So anyway, an investor brings in, his skin into your business, he can bring some synergy into your business, and then you offer your equity to that. So that is the strategic investor. There are family office and private equity. Some business family, they have got surplus fund. On relationship or on certain references, they are ready to invest into the business which they think can generate good return. And third, depending upon the scale of your requirement, of course, IPO is an option. So when we are evaluating or touching upon the equity investment, let's see how the investor sees an investment opportunity. How does it start with? Generally, when investors contemplate to invest in certain business, he does not look at your balance sheet directly, or he does not look at how much turnover you are having or how much profitability you are having. The first thing is, he look at the sector, in which sector you are having. What is the attractiveness of that sector? Is that sector is showing growth? Whether it is promising? What is the entry barrier? What are the exit? What are the characteristics of that sector? If he is satisfied and if he sees that this sector is promising, then he will consider, and then he will come back to the company. Then he will look at the company, what is so special in this company within this particular sector, how it is better than other peers, what competitive advantage does it have. The third thing is use of fund. Okay, this company is good, why this company requires such a fund, where he is going to employ, and when this fund is employed, how is it going to increase the value of the business or improve the business. And fourth is the confidence. They also look at, because it is basically a risk. Investing into an unknown business is risk, so he wants some assurance or some confidence from the promoters where he is going to invest. And that confidence can come from your explanation of your business, risk factor, and how you plan or you contemplate to address those risks. So let's have a look at the perception from the investor from the sector-wise. It's a pyramid of valuation or the perception. If you look at the bottom is a commodity trading and commodity manufacturing. That means it is a very, very common segment which fetches comparatively lower valuation as compared to the company or the segment which goes on the top of the pyramid. So we have to ask questions to ourselves, in which sector or where in this pyramid do we place ourselves, and start discussing about the investment opportunity. So the first questions or the first reply is, many of you must be thinking that the cashew being a commodity, we fall into the commodity segment. Am I correct? Do everybody feel that we are into the commodity segment? I would beg to differ with you. Even though the cashew is a commodity as a raw cashew is a commodity as a raw material, not necessarily kernels are the commodity. The commodity we purchase, we sell, get the margin. Remember, think what you are doing after receiving raw cashew nut. There is a whole lot of conversion process, and each processor has different capability. You take two processors, both purchase the same quality of RCN from the same origin at the same price, and one have a better margin, better recovery than other. So that conversion capability takes away you from the commodity definition. The second thing is, look at the application of the usage of cashew. Just after in the afternoon, we are going to have a cashew Mohotsav, Kaju Mohotsav. How many different application or the usage we find about the cashew? So even though the raw cashew nut, RCN, is a commodity, we can easily argue that depending upon our processing capability, competitive edge that we can develop, and the kind of distribution channel, marketing channel, and the usage of the raw cashew kernel, we can easily define or the project or position it as a consumer, fast-moving consumer goods. This perception, to drive this perception to the investor, all depends upon the kind of processing capability and the marketing capability you can demonstrate to them, rather than just relying upon that being in cashew industry, we are in the commodity business. Still, many of the investors will ask this common question and they will have a concern. Commodity valuation, as I explained you, we are not commodity, we should position as a consumer product. RCN price volatility. Any investor comes, he is aware about that RCN prices are very volatile, being an agriculture company, commodity being imported, international forces or situation play a role on the pricing. So this is one of the factors that every investor accept as a, perceive as a risk factor. Then RCN availability itself is one of the concern. Seasonality, slack season. Not all 12 months your plant will operate on 100% production capacity. There are months, either because of festival season or because of the raw material is not available or because of the demand is not there. It makes sense to run your plant at the lower capacity than the full capacity. So that seasonality and the slack period might also pose a kind of a risk factor in eyes of the investor, and that has to be addressed. Low temporary capacity utilization, that is what, and the margin volatility. Of course, it is linked with the price volatility of the RCN. So how we can address those concerns as a processor? If you are discussing with an investor and he through all these questions that we discussed in my previous slide, how we can address them? The first and most important and the most critical success factor in my opinion or my little experience interacting with the cashew processor is the parity analysis. Your fat is sealed when you make the purchase decision for the particular RCN. And that parity decision or the parity analysis comes with your experience, with your knowledge about the source, and with your knowledge and control over your processing operation back in your factory. So the price volatility you can always counter with the parity analysis, how better parity analysis or how better, what factor you consider while purchasing RCN, and ensure that you are making a logical, sound, and economically sound decision. Operating data. Purchasing parity analysis is all assumption. You are depending upon the origin you are assuming. But during your process, during your history, you always maintain origin-wise data, season-wise data, that I assume this parity, my actual performance is this is a deviation, these are the reasons which are logical, and you create the track record, you create the data, and show your edge or your expertise in selection or the purchase decision process. Plan seasonality. If you are aware that in month of August because of, or month of September because of festive, I am going to run my plant only for 16 days. Or in the last quarter, I am going to run my capacity only on 20% capacity. Then it has to be built into your business plan.
Parasji, you have to speed up.
So these are the questions. So the important thing when we look at the equity is the valuation. Now valuation comes from three factors: the sustainable earning, the justifiable multiple, and the risk discount. Sustainable earning comes from our track record. Justifiable multiple comes from our competitive advantage, and risk, how we identify the risk for the cashew industry. So all put together will help you improve your better valuation whenever you go for the equity option. So when we consider equity option, once again the question is, one of the alternative is IPO. And when we consider IPO, everybody thinks, should I go for IPO or shouldn't I? As he mentioned, IPO is not the free capital, but it is kind of, it carries lots of responsibility and risk together. So when you consider IPO, promoters have these doubts in their mind, which you need to answer to yourselves. So to conclude my presentation, for considering any of your capital source, you must ask these 5 questions: why this capital is needed, which finance options are available, what supports or hinders each capital sources that you are contemplating, and what personal, operational, and strategic choice that you have to make while selecting either debt or equity or IPO as a route for your capital raising. And are we ready to live with those choices once we make, because it has got long-term implications. So these are what about the kind of capital challenges, the sources, and implication while deciding any of the capital options. Thank you very much. If you have any questions, you can always ask, or we can meet one-to-one. Thank you very much.
Thank you, Parasji. So I think straight away we'll start with the Q&A. First, I have a few questions, I think, which are important. So, Sevaji, what changed in your life as a promoter after listing in decision making, reporting, board processes, investor communication, the way you run your company? Which change was more difficult than you expected, and which was easier?
I think before we listed, we prepared ourselves for at least 12 to 18 months for what is coming once the stock gets listed. Being a professional founder-based group that we are running this company, we actually practice all the activities much before. It's very difficult to have, the initial thing was having a formal way of board meetings. Okay, because when you are a kind of a proprietary or partnership firm, you basically take decisions and just go on in your life. But that's not the case when you are a company or a company which is also listed. So you're having those proper compliance mechanism, having those board meetings, having those things before even you going for a listing process is something that we had already done. The change that we saw was the way the investors interactions happens, you know. As Mohit said, you know, the bankers will come to you. But for the investors, you need to preempt what they are looking towards, what is that they want you to inform them. At the same time, remain compliant in what you can give within the purview of the regulations. So that change, again, not very difficult. It just requires you to really have some experts on board. And yeah, you can just go ahead with that. So difficulty-wise, I think it's only the mindset that you need to prepare for, that people can ask you questions, you know. That's exactly you need to really be aware of.
If another cashew processor asked you today, what should I do 1 or 2 years before starting IPO journey, as you told that you have started working 12 to 18 months before that. So what 3 things would you tell them to put in order first? And is there anything you would do differently if you are starting again?
So the 3 things that any business actually needs to have, one is that you need to really demonstrate, as far as he said, the confidence and the strategy that you have, okay, because that is where people will really like to understand how do you want to grow, because equity is a growth capital. Equity is not an innovation capital, neither an acquisition capital, neither an sustenance capital. It's a growth capital. People would like to become a co-passenger with you in the growth journey that you are likely to perform for. So you need to really have that strategy right. You need to have that strategy long-term right. And that consistency in your strategy needs to be well addressed. The second thing would be the management. At the end of the day, everything is a non-active resource. It's only active resource is the people. So it's the people, the management that really makes or breaks the things. So your management, your maybe the investors, the founders itself, or the management which is professionally hired by you, will be something that they will look forward to. And that's what you need to really be aware of. The third is the ability to execute. Past, present, and the future is what you need to be very clear on, is how do you will execute your strategy. So there are three parts of it, because at the end of the day, the execution is very clear and it's in multiplication. So nothing like, you know, you don't have one, the other two will be happy for you. It's a multiplying effect. So anything becomes 0, the final output is 0. So that's the 3 key aspects. I don't think so I would have done anything differently. Because we really prepared ourselves from probably 2000 times. At 2020, we prepared ourselves to take this journey. Yeah, it only thing would have been that, you know, probably we would have looked for a private equity, but we were not looking for someone to give us a direction. We were clear about the direction. So we just were looking for someone to come along with us.
Thank you. Mohit ji, for you, the cashew industry has traditionally relied on promoter capital and bank finances. At what point should a processor start looking beyond bank finances, and what alternate should we realistically consider?
Yep. So before answering this question, the question which you asked to Hozefa ji, what change do you see after getting listed? So I can tell it from an investor's perspective that in any privately held business, you can stop at some point. Yeah, I'll not grow for next 1 year. But once you get listed, then investors will be behind you Why are you stopping at 140? Why not 240? Why not 340? So that is the biggest change. I think once you get listed, then it is not only you, but it is your public investors, it is your all private equity investors or pre-IPO investors who will be behind you for more and more growth. They will keep asking you, why are you not growing? So that will also, I think it is not a challenge, it is a change, it is a good change. So coming back to the question, when should any cashew company, any cashew processor, because I think most of you will be RCN processors. So when should one company look at the public market? So prior to the public market, is mentioned by sir that you can have multiple options which you can evaluate. It can be quasi equity, it can be structured debt, it can be, then you can go for equity. And in the, I think, initial conversation, initial discussion, Hozefa ji has said that debt is the cheapest option, equity is the costliest. So as long as you can go for debt, I think that is the best option. But there are certain limitations which I find as an investor in this industry, that once you grow to a certain extent and you want to increase your margins, you want to build your supply chain stronger, your working capital requirement increases. And for any project, let's say if you are at 20 tons per day of RCN processing, now you want to expand your capacity, the capex, the capital expenditure requirement is not that significant. The working capital requirement, if you go deeper into the value chain, if you go into direct sourcing from certain regions like Africa or even from India, then you need that working capital. And at that time, I think you should decide whether you should go public, whether you should go for any private equity round. Because what I have understood in this industry is when you are sourcing directly from Africa, you will need cash. So you will have to pay upfront. So banks might find it a bit difficult because you will be sourcing from outside India. So the biggest bottleneck for this industry is working capital. And at one point of time, when you have scaled your capacity to a certain level, then I think for working capital, it is a right time to go public. One suggestion for everyone, I think, never raise capital for debt repayment. That is not a growth capital. You might increase your profits, you might save on finance cost. The public raising should be done only for growth, only and only for growth. So first point, when you want to go deeper into the value chain, you need working capital, one point. But there will be many companies who are not even focusing primarily on cashew processing, but more into brand building. So when you want to grow your brand, you will need higher marketing expenses. So that is also a good time when you should think, yeah, now I'm ready. I have come to a certain scale where I can go for a public listing. I can share my rewards, I can take that responsibility. I will survive, I will sustain my growth. So when you feel confident that you can sustain the growth and with the public capital, you can even fast track that growth, that is the right time to go public. And I think this is a pretty interesting industry as well from any investor's perspective as well. But in this industry, I think once you stop growing, you will not survive. So you should keep on growing, and for that, you will at one point of time need public equity.
Thank you. One more question for you. What are the most common mistakes promoters generally make during IPO process, particularly around disclosure, documentation, execution, and how they can avoid them, basically those mistakes?
The first mistake, even before documentation disclosure, is appointing right advisors. So if your advisor is not right, then you will, I think, face certain challenges in the next 3 or 5 years, even after IPO. So appointing right advisors is the first point. He will take care of the disclosures, documentation, and all. Appointing right merchant bankers. So for that, yeah, it is very subjective. So whatever we are discussing from the public market point, I think what sir has presented, everything is subjective. So once you have right advisors in place, they will guide you about documentation, they will guide you about disclosures. But one thing on which you should focus, especially is once, let's say if you are going for an IPO, then you will have to file a draft red herring prospectus, DRHP. So once your DRHP is published, it will remain in the public for next 30, 40, 50, till your existence. It will remain in the public. So at the time of filing your DRHP, there should be certain things which you should manage. Let's say if there are any dues, if there are any settlements which needs to be done. So it should be done. If it can be done, then it should be done prior to the DRHP filing. There are certain, so as an investor, let's say you are sourcing raw cashew nut from Africa. And you are routing it through any of your entity, there would be some related party transaction. So an investor will say, yeah, this is a normal practice in the industry. You will have to route it through your any of your entity. But in that you will need disclosure. So any kind of disclosure will need clarification. Any kind of information which you put in your DRHP, and your advisor will tell you that, yeah, this is something which investors will question, and investors might have some objection on this, and you need to put a certain clarification on that point, so that even before any question comes up, you have already written the answer in your DRHP. So appointing right set of advisors, appointing right set of merchant bankers to your issue, that is the I think most important, most critical thing in your journey towards IPO.
Now actually we are already running out of time, so I'll just ask last question to Paraji. We all have bad experiences or tricky experiences with consultants. So this is a more for, as a consultant you have to reply. When client approaches you for advice on equity or strategic finance, what process do you generally follow, and how you ensure that financing solution is genuinely in client interest, long-term interest basically? So, yeah.
Yeah, it's a very relevant question. If any client comes to me with this question, I will not consider it as a consultancy with respect to the capital raise. First, I will try to understand the business of the client. What business he is in, what are his plans, what are the promoter's vision, and what are his current source of capital, and where does this current source of capital falling short of his vision. After evaluating this vision and the purpose for the new capital, additional capital raise, we'll try to evaluate different capital options, different fund options, or combination of capital sources for that particular vision or reason. It could be a partly debt or partly equity. So after having zero into the capital mix, which suits its vision and business objective, then second question is how that business or the company is ready or prepared for accepting, particularly in case of equity. So the thing comes with the business diagnostics. I personally stress or put very big emphasis on the business diagnostics, whereby we will try to identify the gaps which are existing into the business in order to be qualified or in order to generate confidence or the better valuation in eyes of the investor. So this business diagnostics is the most critical part, particularly when you are raising any equity, be it from the private equity, be it from the family office, or more importantly so, from the IPO perspective. Now these business diagnostics unearth or kind of try to focus on the financial format, the restatement, internal financial control, the governance, the depth of people within that, and the use of capital or complete business plan. So these are the kind of things we would like to focus on. And after identifying those gaps, we propose the action plan. In fact, in order to make it more formal and more robust, we have very diligently developed a business diagnostic tool where we test the company in all the cross-section of each and every aspect of the business and identify the gap and give them the specific solution for deploying them. And then in this total scenario, we try to zero it down, how to go about this capital raise.
Can I take this audience question? One? Yeah, maybe he can, maybe you can answer this question, which is on the screen.
Actually, we have already addressed this, that, you know, that it's yes, answer is yes, debt is always cheaper compared to the equity. And slightly extended answer would be that you need to understand the purpose, exactly where you require it. And once you understand it, it is always that we all are businessmen, we will always go for the cheapest thing that we can source from. So answer is pretty much yes.
Actually, we had put one question. Many of the cashew businesses are still proprietary. Proprietary versus some form of limited company. Any thoughts on that?
I actually answered that as well in a way that I said, you know, you need to really understand what is where you want to go and start building yourself towards that. So you can't have a limited company being listed on and you being a proprietor, right? The governance structure, the management team, the way your strategy is, the way you execute it, these all is required, because remember this, you know, the risk and reward is what an investor will look for. He is giving you a money where you can probably take it $100 and say all went zero, okay, and then nothing can be done by him. So that person is coming with significant amount of question marks and risk understanding with you. And these are parameters where you typically will evaluate you. So unless he is confident of the fact that, you know, you are going to make some returns out of it and it will be in his favor, he would not really look for this. So proprietary structures won't work. You know, the first and very simple thing is neither the proprietary, neither the partnership structure will work. You will have to come to the company level. But there are companies, we also understand, you know, there are companies which is basically driven by one-man decision. That would not work in any way in a listed company.
Yeah, mainly I think it has to more with the fighting individual proprietors' mental framework, you know, whether he want to run business transparently, he want to disclose few things, he wants to grow and take it to the next level, or he wants to control everything. And so I think that's, anyway, I think we have already overshoot the time. So I thank entire panel and audience for patient listening. And I hope it must be useful for you. Thank you very much.
Thank you, gentlemen. Without taking any further time, a big thank you, everyone. And I'd like to request Mr. Veeral Desai one final time to present a memento to all our very valued, esteemed contributors to this panel.